Our next guest says this market rally has even more room to run. Let's bring in JP Morgan's Phil Camporeale. Phil, great to have you with us.
Welcome back, Melissa. Good talking to you again.
Thank you, Phil. Great to be back. In terms of the market going higher, what's going to drive this? And are you factoring in at all a resumption or an increase in U.S.-China relations? Tensions,
yeah, that's a good question. Yeah, that's a good question, Melissa. This has been an incredibly emotional and confusing market environment for the past couple of months, even for the most tenured investors, right? I mean, the unemployment rate has gone from a 50-year low to a 80-year high in just 2 months. And 1 out of every 4 trading days, this market has gone plus or minus 3% in a day. I mean, that's exhausting, right? And we're also sitting on top of the second best 40-day stretch in market history. The reason why I think that you can continue to press higher is because there are very important technical reasons to continue to like the market. There's $5 trillion right now sitting in money market funds. This time last year, that was $3 trillion. Speculators in futures on the S&P 500 are the shortest since 2016. Remember those Brexit days and the November election. But really what we're doing, Melissa, is taking our cues from financial conditions. If March 23rd ends up being the bottom, it'll get remembered like March 9th gets remembered in 2009. But really, it was what the Fed said that day. Yes, the market bottomed on March 23rd, but what the Fed did that day was announce their corporate credit facilities. And everybody thought, okay, maybe this will help fixed income and corporate credit. But what that did in terms of improving things like LIBOR, the VIX is below 28 now. Credit spreads have come materially tighter in. So all of that is feeding upon the strong technicals in the S&P. The other thing is the S&P 500 has a yield of, I don't know, about 2.2% right now versus the 10-year Treasury at 70 basis points. We've never seen that before. So you add on top of all the technicals, and I always say things don't move by 30% in 40 days because everyone is investing. Unless those technicals start to change, Melissa, which we don't see changing anytime soon, right, dips should be bought here.
So I want to get back to the money sitting on the sidelines because I feel like we hear that a lot. So you're saying that over the past year, money sitting on the sidelines in money market accounts has increased by $2 trillion. To the best of your knowledge, Phil, who is the primary owner of these money market accounts? I'm just trying to understand whether or not the holder of these accounts, if they're hoarding cash because they're concerned, and so therefore that cash may sit on those sidelines for much longer until we have a better grip on how this is all going to play out.
Yeah, Melissa, that's a good question. The slope of that line really steepened in February and March of this year. So that looks to us like it's a retail-like flow, right, where Main Street has flown to the sidelines. They've run for the hills. And that's less the case in institutional space where folks stay rebalanced and they continue to add like they did at the end of the first quarter. But that's a FOMO trade like I've never seen before, right? And I think that's going to, and it's so expensive to sit on the sidelines because cash rates are 0. And if you want to go to government bonds, they're at 70 basis. Like, where are you going to go? And that's why the improvement in things like LIBOR and credit spreads, and even the fact that companies like Live Nation and companies like cruise lines have been able to issue debt in this market is an important bridge loan for these companies. The Fed has been absolutely heroic and creative. And I think that that corporate credit facility is going to go down in history of one of the most important things they've ever done.
All right. So you dropped your equity allocations by 20% in March. I'm curious, when did you drop? When in March did you drop it? Because it's a pretty critical time to decide to drop your equity allocations, to, depending on when you did it. If it was before the dip or after the dip or what?
Yeah, that's a critical question there, Melissa. So this was towards the middle of February when it was clear to us. Remember when Apple came out and Apple was like, okay, this is more than a supply side issue. We may not be able to get the demand. This was towards the middle of February that we started to drop our equity allocation. And we started adding back the Friday before the March 23rd low for the reasons of, okay, now we have a Federal Reserve that's committed to avoiding the worst case scenario, which is a run on cash. We have a totally bipartisan wartime spending initiative from Congress. The CARES Act passed 96 to nothing. And then the third thing was the fact that, there was a major rebalancing that was going to occur at the end of the first quarter. Right. So we started to add back then, and then we've slowly been adding back to get to a neutral allocation. But I want to be clear here, Melissa. there are plenty of fundamental headwinds that we're going to face.
Okay.
It's really hard to get to an overweight without more clarity on that. And we would agree with some of the comments you were making in terms of the U.S.-China relationship, especially heading into the election. But
right.
The other thing that we know is that if the market sells off, those relations tend to improve.
Okay. Phil, great to speak with you. Thank you.
Thanks, Melissa.
Phil Camporeale, J.P. Morgan Asset Management. I think that's important to be clear. Even though Phil sounded extremely bullish all throughout the interview, he is not overweight equities at this point, Dan. And I think that that's very important to walk away with, that you can be constructive here because of what you're seeing in the markets, but not be, pounding the table.
Yeah, listen, the price action is hard not to be constructive about. The S&P 500 is getting back to a level near 3,000, where if you look at it, the 200-day moving average right there, it was the level it broke out in late October. I am not getting constructive on equities here because of the last point that he made about the headwinds going forward. Yes, there were many actions taken by the Fed that will be in history deemed to be historic, but maybe that's because we have historic levels of unemployment that are going to take years and years to kind of work off. And the fact is that we have our consumer-led economy, and our consumer is going to be constrained for some while. So listen, I've been wrong for the last month and a half, but the stock market, the S&P 500 has been trading between 2,800 and 2,950 or 60 or so. How wrong is that when one day could put you back at the low end of the range or the high end of the range? I do not expect a breakout in a meaningful way anytime soon because a lot of this stimulus and assistance has been front end loaded, and it doesn't seem like there is tremendous demand for more of that in Washington right now. So the way I see it is this. Listen, the economy sucked last year. If you take out the Fed cuts and you take out the QE in the fall, yes, the stock market, what did it do? It got risk assets going higher. But without that, we just did not have a great economy. Now the economy is really bad. The stock market is down 8% on the year. I just don't see it as a great spot to get back into equities. One last point about all that cash on the sidelines that's getting in right now. Any bad news in the next few weeks, next few months, that's going to act as like an accelerant to the downside because those people are going to be, that stock is going to be in very weak hands, in my opinion.